Hi, my name is Kunal Khanna, and thank you for the fantastic response that you gave to our previous interaction with Mr. Gaurav Mehta, CIO alternates at SBI Funds Management, with regards to your investments in AEON Alpha. Gaurav, welcome for the second edition. It's been a very volatile market in the last, few months, where you've seen the markets run, from a time correction to a lifetime high, and you've again seen some bit of correction coming in the last few weeks. What is your take on the market? Because Aeon Alpha as a strategy has had a fantastic run over the last 1.5 years since its inception in Jan 2022. What do you feel from here? How is this product going to behave going forward? As an investor, because I've come in with a 3 to 4 year view, what should be my view or my next move as far as the investment is concerned? Should I add more? What should I do at this point in time?
So Kunal, I think the basic portfolio construction of Aeon Alpha, if I were to put it in a very simple fashion, is to look at a core portfolio and to have a satellite portfolio and have both of them running together. And usually, for the last 18 odd months, we've had a close to 50% split between the two. So half of the portfolio is core, half of the portfolio is satellite. The way we think about core stocks is stocks essentially where we can buy and hold them forever. Essentially these are good companies which we think will keep compounding at a certain pace for the next several years, and which is why you don't have to really worry about market timing or timing of a macro cycle and so on, because these are either in sectors, essentially these are in sectors which are relatively structural sectors, and these are run by managements who have seen these cycles and they have navigated these cycles well in the past. So you don't have to really worry about macro cycles and so on. And then this core piece is supplemented by the satellite piece, which, as I said, is for the last 18 odd months has been close to half of the portfolio, where you are thinking of any themes either at the macro economy level, a sector level, or at the micro level, which is likely to last for the next 2 to 3 years, even longer hopefully. But the difference between this piece and the core piece is that these are not buy and forget names. You're essentially playing a macro or a micro theme, which may last for the next 3 years, 5 years, 7 years, but you have to keep an active watch on that. And I think it's this combination that's really worked well for us. Last 6 months have been very conducive for the satellite piece of the portfolio because a lot of these economy-facing sectors have come back to life. They've done very well. If you go back in time, let's say a good part of 2022, for example, was not a very optimistic market environment. It was a very turbulent market phase. But during that period, the fact that you had 50% of your portfolio in core, it provided a solidity to the portfolio. So the way we think about this is that core provides solidity to the portfolio, satellite adds a bit of non-linearity, so that even in falling markets, you have some solidity, and in rising markets, you have some upside participation through the satellite piece. And, which is why, yes, markets are what they are, and there have been tailwinds when broader markets have done very well for the last 6 odd months. That's obviously helped the portfolio. But then, if you go back in time, again, as I said, in 2022, when broader markets were not very positive, even then the portfolio was holding steady. So I think this balance of core satellite is something that we think should continue to work well for investors, and which is why your need to time shorter term market cycles or style shifts and so on, it sort of tries to make it a little immune to all of that.
So that actually sounds very reassuring, especially in times when you switch on the television, you see everything in the red. So sounds very reassuring. Stick to your asset allocation, and if you come in with a 3 to 4 year kind of a view, I think we should just sit back. We've seen a phenomenal year, and have confidence in the fund management. I'm sure the next 2 to 3 years, leaving out the short term volatility, because we are in a year where we see elections coming up, in a couple of states and in general elections next year. But we have a team which is going to take care. So that's very reassuring from an investor perspective. Again, apart from the two things, Gaurav, that you mentioned on the core and the satellite piece, there is a third aspect to this particular portfolio, which is the asset allocation model. And we have mentioned not in the short term, because that would again amount to a lot of capital gains tax, not very frequently, but whenever your asset allocation model suggests that the market could actually correct in a big way, we could take up to 35% cash in the portfolio. Now, as I mentioned, this is not going to be something that we keep doing every year. We're not going to do this if general elections are next year. But if you could just explain to our investors what this asset allocation model is, just from a comforting perspective, and have you done some back testing on this model? How does this actually work from an investor perspective?
Right. So I think there are three specific aspects to this asset allocation framework, and all of them are pretty simple and pretty intuitive if you think about it. At any point in time, the market level is a function of two things: valuations and earnings. So valuation and earnings are two important aspects of this allocation framework. And the third thing that we've also tried to bring in is to look at market sentiment, to quantify market sentiment, because we know that markets go through their own greed and fear cycles, and you ideally should be a contrarian. So when everyone is greedy, you should act as a contrarian and buy and sell. Sorry, and when everyone is fearful, is when you should act as a contrarian and buy. And this combination of these three facts, these three pillars, right, valuations, earnings, and market sentiment, is something that our asset allocation framework is derived of. The 35% cash call will happen when all three of these are pointing towards a negative outlook, right? So which is to say that when valuations are very expensive, when market sentiment is very euphoric, and when earnings have seen a big upcycle and are sitting at some sort of a top, is when you will want to go to 35% cash. But this combination doesn't happen very frequently. It'll let max happen once every 4-5 years or so, maybe even longer. In all other market settings, for example, the last 18 odd months since we've been running this portfolio, more like 20 months now that we've been running this portfolio, we've never had to go to 35% cash, because while valuations have been stretched, earnings have been coming through, and so on. The other aspect that I also want to highlight is that you talked about elections, and there are several of these events that keep coming which have the potential of moving markets. But this is not a product where we will take subjective views on events or the outcomes of those events. We'll always go back and rely on our asset allocation framework, which is a very objective framework where I don't have to take a subjective view of anything. Everything is objective there. And only when that framework tells me that all three pillars are pointing to some sort of a big down move in the markets, is when we'll go to 35% cash. In all other market settings, this is a typical long only portfolio, and which is why you should think of it as a I talked about the core satellite approach. I think that's going to be a bigger driver of returns. The bottom up stock selection is going to be a bigger driver of returns rather than the cash call. But in extreme cases, taking that cash call ahead of a big drawdown not only helps you protect the drawdown better, but also on the other side gives you enough firepower to go in when there are lots of bargains available. So I think that's how we're thinking of this product overall.
Very interesting, Gaurav. And you also mentioned about bottom-up stock selection. And I think as a fund house, SBI Funds Management has been known for picking up, mid and small caps. And we've seen the success of our small cap fund, which has been one of the best performing small caps over a decade. And when you talk about small caps, the entire industry has actually been talking, but there's a lot of buzz that the valuation on the small cap side, the mid cap side is very stretched. Large caps look better. But when you talk about AEON Alpha, we have 55% of our money in small caps, 18% in mid caps. Balance obviously is in large cap. We also have some amount of cash in the portfolio. Now, how confident are we as far as our portfolio is concerned? Because as we both know, we're not going to churn too much in the portfolio just because the short-term markets are not looking great. So, how confident are we as far as our mid and small cap selections in the stock is concerned?
I think very good question, Kunal, because a lot of investors are thinking of on exactly those lines at this point in time. And whichever way you look at it, small caps have had a very good run over the last few months. If you look at the market cap polarization between large caps and between broader markets, then obviously that's skewed in favor of broader markets now. And if that reverts back, then that would mean that large caps are better, on a relative basis. But again, in all of this is very here and now. The way we think about stock picking, and which in a way sort of covers this aspect of market capitalization, I want to sort of summarize it in 3 points. The first is you always have to keep base rates in mind. If you think of large caps in India, there are only 100 large caps, and the next 150 are mid caps. And so there are only 250 large and mid caps in India. There's a long tail of small caps beyond that. Even if you were to think that only top 1000 stocks are investable, and that still leaves you with 750 small caps beyond large and mid cap names, right? Now, if you were to create a portfolio within that 1000, and you were sort of agnostic to market caps, you're just thinking of identifying good companies, then you will have a portfolio which has 75% small caps, 15% mid caps, and 10% large caps. It's just that number game, right? So to that extent, if you have a portfolio, for example, AEON, I think today is about 55% in small caps, then I don't know whether I'm underweight small caps or overweight small caps from a base rate point of view. The second way, to think about this is that if you are a long-term investor, what are you betting on? You're betting on two things. A, will I get earnings non-linearity? And we know that smaller businesses have a longer runway of growing non-linearity on earnings than a more mature business model. So which, obviously again skews you towards small caps. And alongside the fact that there is research arbitrage that still exists in small caps, because a lot of mutual fund AEONs have become so large that the research arbitrage in large caps and potentially a lot of mid caps is already exploited well. But because of those large sizes, they can't sort of play the small cap space as well. And to that extent, there still is research arbitrage that's available in small caps. So this combination of higher potential earnings growth and still existent research arbitrage, again, would think that a longer term investor will have more small caps in their portfolio than large and mid caps. And the third aspect is that entire bottom up stock selection piece, right? If you have to, in EON Alpha, we just run 20 stocks portfolios. So if you have to buy, let's say 7-8 good quality small caps from a basket of 750 small caps, then your ability to pick and choose and do that rigorous bottom up stock selection is that much higher. And which is why you can still choose stocks while they, from a market capitalization point of view, they are small caps, but from a balance sheet strength point of view, from a profitability point of view, from a leverage point of view, in addition to the non-linear growth, they are as good or better than a lot of large caps. And in fact, if you look at the EON Alpha portfolio in totality, the ROEs, the debt equity ratios, even beta for that matter, are much more, are much better contained than even the Nifty 50. And that obviously is again something that works in favor of small caps. So, we're not thinking of this product so much as an allocation call between large caps or mid caps or multi caps. We're thinking of it as a long-term portfolio where, because of base rate or because of non-linear growth, because of research arbitrage, and because of your ability to still have a robust portfolio in terms of balance sheet and profitability, etc., you would still end up with more small caps than large caps in the portfolio. And I think for long-term investors, that should be the key guiding principle rather than thinking so much about the here and now valuations.
So very interesting perspective, Gaurav. And you did mention how mutual funds have been seeing a lot of flows, in the last few years, right? And we've seen how the HNI investors, because they know they have a higher risk appetite, they've allocated a lot of money to mid and small cap funds. And in the last few months, we've seen a lot of fund houses actually stopping fresh lump sum allocation in their small cap funds. So from an HNI perspective, if I want to still, as per my asset allocation, allocate money to small caps, I think PMS, AIFs are the products which make a lot of sense. But coming to my last question, for today, Gaurav, is you did mention about a concentrated portfolio, and AEON has a 20 stock portfolio. Now, do you think in some way this hampers your ability to pick up a fresh idea, just in case 3 months later there's an IPO that comes out? Now you have a restriction that you cannot buy the 21st stock. You keep it to a crisp 20 stock portfolio. So do you think at any point in time does it hamper your ability to maybe buy a new stock, a fresh idea that comes to your mind?
I think it cuts both ways, Kunal. You always would want to, buy the flavor of the season, and as a result, have a portfolio which has a lot of stocks. But I think there's plenty of research out there which suggests that at around 15-20 stocks in a portfolio, you achieve sufficient diversification. If you were to think of one reason to have a larger number of stocks in the portfolio, it is diversification. And at 15-20 stocks, you achieve decent diversification in the portfolio. The flip side is that when you buy 20 stocks, you buy, on an average, each stock is 5% of the portfolio, right? And that in turn allows you to participate in the wealth generation that happens when that stock or that company does well. When you're a very sort of diversified portfolio, the amount of positive attribution that the portfolio gets because of your stock selection also then gets sort of scattered to that extent. So which is why we think that 20 is a good number where you are diversified enough from a risk standpoint, but you're still concentrated enough that if a selection works out well in your favor, then that allows you to see those benefits in the at the portfolio level. And a related aspect is that if you're only running a 20 stock portfolio, with each stock being average 5% of the portfolio, the amount of rigor that you have to put in terms of identifying that stock and then monitoring it on on an ongoing basis also goes up, and that hopefully is something that should work in investors' favor if we are doing our job well. So overall, I think we are very comfortable with that concentrated strategy of 20 odd stocks, and yeah, I mean hopefully that should continue to deliver for investors as well.
Sure, 20, 25, 30. If an investor's made 35% return on a 1 year basis, I'm sure he has no reason to complain with the number of stocks, which means that you've actually done a phenomenal job. But again, thank you for this opportunity. Thank you for joining us. For listening to this video. And as promised, we'll actually come back again next quarter with a fresh set of questions with Gaurav. Thank you for loving. Thank you.
Thank you.